New Fed chair, tax reform, all-time highs yet again. But there are signs that are being ignored. Stay tuned, we'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV. First up, don't forget to subscribe to our page. Also, here in the left-hand corner, Weekend Wisdom, a new series. Make sure you watch that. We just put out another one this weekend. Is consumer confidence a con? Below, you can click on Show More for links to additional information on today's video and also a way to contact me with any questions. Speaking of questions, here's one from a viewer last week. Which signals do you like most and why? Well, when I do my research and the charting programs that I use, there's literally a ton. I focus on four in these videos to keep it consistent. RSI, relative strength. MACD, which is momentum. I'm looking for moving averages. And then I look for bullish flags for entry points. And I'll show a little bit more on today's videos. So, let's get to the numbers. Last week, like I said, green, green, and more green. Once again, euphoria continues despite some signs, and we will talk about that. So let's go to the big charts. First up, the Dow, 56th all-time high this year. The last time we saw that, 1987, and surely that was an interesting year. So what are we seeing here? Pretty much the same. Momentum continues to point up, although we're button hooking there at the end, so I think we're overdue for a pause, to say the least. RSI, relative strength, remember, above 70 is overbought. Now, you can go over and come back, but if you sustain, that is considered very bullish, which has been happening for quite some time, but not quite seeing a crossover in MACD, but it looks like it's turning down and ready to do so. First sign, Dow theory. Transports and Dow hitting all-time highs together. Very bullish, but look at transports. Lower high, lower high, lower high, breaking down. So interesting. S&P, what do we see here? Obviously a great looking chart. Consolidation, breakout 3%, consolidation 3%. Pretty consistent here, okay, over the last 4 or 5 consolidations. But we're looking here, momentum kind of sideways. Now, we did go down a little bit on the S&P and then came up to right at the 70 line based on some big techs earnings last week driving us up. So, here's a chart that definitely is another sign. All right, so what we have is green is the S&P, all-time highs, as we said. The red line, though, are companies in the S&P below its 50-day moving average. So here, we had a big divergence. We're going down there, and yet we hit all-time highs, so a little bit concerning. The next one I've showed for a while here, S&P going up, and then we have the S&P equal weight versus the S&P. So again, equal weight. Every company gets 1/500th of a share, okay? The S&P is cap weighted, so big tech is going to get a higher number. Look at that right there. That is really seeing some big divergence there, and it shows the underlying breadth of the market is starting to break down. How about the NASDAQ? Here's the NASDAQ 100, which is where we are. Same thing we're seeing here. Now here you see a definitive bullish flag, and then you break out. So those are entry points, the pullbacks, right? When they say buy the dip, those usually set up if they hold and do nicely. And we saw last week we had a bullish flag and then breakouts to all-time highs. Momentum continues to point up. At the top there we have RSI, which has been in overbought conditions, again, it's staying above 70, is okay. But what about behind the scenes? Same look here. So here's the NASDAQ 100 equal weight versus the NASDAQ 100. You look at the divergence there, that is an all-time low that we hit at the end of last week. So again, no breath. It's really being driven by a select few big tech names, and that is definitely concerning. We see it here as well on the moving day averages. So the first chart is your 200-day moving average. Now remember, 200 days, it should be a smoother ride, but we are seeing divergence. S&P, NASDAQ, mid-cap, small-cap, each of them are pointing down. So long-term, not a lot of concern, but let's look short-term. So 50-day, we talked about that in the S&P. You see that breaking down. NASDAQ 100 below 60, above 60 bullish, below 40 is bearish. So we've broken 60, not at 40 yet. And you look at small and mids, really, again, breaking down. So another sign that we see some deterioration, at least on the short term. I'm not going to worry about the long-term view yet, but right now, I would really expect that kind of consolidation period because we've gone so far. So, how expensive is the market? How about really expensive? Now, here is the Buffett indicator, excuse me. Warren Buffett came up with this, and it's basically corporate equities to GDP, 134%. That's the highest number in every period, every pre-crash period except 2000, which was just about the dot-com. And as I said before, this is the everything bubble. We're just going up. So let's look at CAPE, cyclically adjusted price earnings. That's what we use. The Robert Shiller, we'll have a link down there. 31.57. Wow, is that a big number? So let's think about it. This chart right here, the S&P, we're showing if we were at 20 on the CAPE, we'd be at 2080. 15, which is fair value, that's the normal, would be 1560. And then 10, which would be undervalue, would be 1040. So let's add another little chart here and say, okay, same thing, top to bottom in those numbers, what would that look like? Well, 20 on the S&P would be a loss of 19.2%. 15, how about 39.5? And 10 at fair value, 59.6. So, yeah, we are way overpriced right now, and that is a definitive concern. Short term, again, we're all in, but let's really be realistic about this market. Next, we have a new Fed chair. Finally, Queen Yellen gone. Wow, she is, I'm not a fan to say the least. So I've talked about this book before, Fed Up, great book. I recommend everyone should read it. I've got a link below. And Danielle Martino Booth, and she talked about her time at the Fed, and she was one of the very, very few non-academics. She didn't have a PhD, and basically how out of touch the Fed was, because it was all academic. They didn't live the real world. Okay? Now the good news is Jay Powell has done that. I also have below an article that Danielle wrote about him last week. Really good article about him. So hopefully we will see some changes in the Fed as we go forward. Here's a little funny chart. They talked about the height of each of the Fed chairs, and we can go back to the 80s with Paul Volcker, 6'6", down to Greenspan, down to Bernanke, Yellen at 5'2". Rates went straight down from 18%, down of course to about nothing. And now we have a 6-foot new Fed chair. So are rates going to follow? Well, we will follow that actually. So how does it affect the treasuries? Well, treasuries last week, very interesting. We saw a move to the downside. So we thought we had were in an upturn. We peaked out at 242. Okay, but ended the week at 234, 2.34. So there seems to be some more pressure to the downside. But yield spread, this is a concern. We got down to a 0.71 last week, and this tells us a couple things. One, the bond market is not believing the stock rush. Two, they're not believing that tax reform is going to make a difference in growth because we see the push into treasuries. The last time we saw 0.71, and you can correlate this any way you want, was pre-crash as it started going down. Remember, we're 0.71. It's the zero number when we get there that we really get concerned. But that trend is not our friend. Next up, sectors. Spent a lot of time in other areas today, so just going to talk about one sector, oil. Been a while. Here's your oil on a weekly view since 2015. Hit our highs, really came crashing down, but we actually broke through a long-term trend line on the weekly view. So here's the daily view. Like it. Had that consolidation box since early 16. We just broke out of it last week. I started dipping in here last week with a few different accounts, but it looks real good. We broke out of a long-term consolidation box. Getting a little bit pricey there, RSI, all right, but momentum is still pointing up, so is it time to get in? Let's see what happens this week. You might see a pullback. We also had some issues in Saudi Arabia this weekend, which might affect prices, so I'm not jumping in, just maybe tiptoeing, and let's see what happens as we go forward. How about the data? Last week across the board, the only ones I'm going to point out, ISM, manufacturing, came down a little bit from an all-time high number, and non-ISM hit an all-time high. Non-ISM, why? Because we had more jobs added on bartenders and waitresses than we've ever seen. So not exactly a great thing. And once again, up was consumer confidence. And as I said, we've got a link to last weekend's video on that topic. How about the consumer? AAII, somewhat contrarian view here, but big surge to the bullish side, 45.1. Neutral 26 and 28.6 on the bear side. So again, this can be thought of as contrarian. Fear and greed came down a little bit last week, 66. 74 a week ago, and it was just a few weeks before that, we're at 91. So this all tells us right now our indicators are short-term, positive, mid-term, positive, long-term positive. But I will tell you, we've had 3 clicks down on the short term. Doesn't mean a lot right now, but we are watching it, which, you know, we do have concerns, like I said today. You know, this is the time, all-time highs, end of year. Look to have your stops in place, take some profits, sell some of your dogs, and get yourself ready for next year. As always, we appreciate you watching. This is Michael Loftus for Wealth and Wisdom TV.